Are there any highlights in these results for you?
Well, 2013 was very much a transition year for us. As you know, the company's got quite a diverse revenue mix, and in order to give us greater predictability of results going forward, we decided to focus on fewer nationally regulated and taxed markets, and that was manifested in our volume to value strategy. I think the highlights of this year were that we substantially managed to exceed our associated cost saving targets. We had targeted 70 million of cost savings and actually delivered 97 million euros. Other highlights, of course, would have been the launch of our new poker product, which has been very well received if you look at the reviews from players. But obviously securing the leading network position in New Jersey, that was our aim, and we're very pleased that we did manage to achieve that. Other highlights, I would say, are if you look at our mobile touch video performance, we grew revenues there by 77%. And we think there's a lot more growth to come in that area because to some extent we are playing catch up with some of our competitors there.
So what are you most disappointed by?
I think we saw obviously a bigger revenue drop off than we had anticipated. As part of the volume to value strategy, we did expect revenues to fall. But of course, we had additional impacts throughout the year coming from the likes of the full year impact of the German tax. We had the ISP blocking at the end of the year from Greece. And some of the regulated markets, in particular poker, where there's ring-fenced liquidity, saw decline. So we did see a greater drop-off than anticipated. And to be fair, we also had some internal factors that impacted our revenue performance, such as the migration losses. When we did the migration of the .com platforms in 2012, we did incur migration losses that were higher than we had expected.
When you break it down, what percentage of this result is market driven? How much is down to your volume to value strategy? And how much is simply company underperformance?
Well, over half was down to external factors. If you look at the internal factors, the majority of that related to our volume to value strategy. But of course, that also allowed us to take out a substantial amount of cost of the business. So that's not necessarily a bad thing that we saw that revenue drop off. And as I said, that was largely in line with our expectations. The main area of company underperformance, as you put it, really was in respect of the migration losses that we saw. And to some extent, we also lost market share in a few markets as well. That, I think, largely down to the fact that our hands have been tied on the technology front whilst the integration has been going on, and we've been playing catch up to some extent on our products. But I'm pleased to say that we're largely there on that front now.
Now, what's been the total impact of ISP blocking in Greece, and how do you think that might be resolved?
Well, in 2012, we did 32 million of revenue in Greece. In 2013, that dropped down to 17 million euros. And frankly, in Q4, the revenue from Greece had all but disappeared. So it's somewhat disappointing that we face that challenge. Obviously, we're hoping that there will be some redress through the European courts, but frankly, that's not a short-term solution.
Costs of sales went down quite substantially in all parts of the business, except for sports betting, where it's increased by 22%. Is all that down to the German tax?
Certainly, the majority of it is down to the full year impact of the German tax on sports betting. Having said that, we did also see increases in gaming duty coming from the likes of Belgium and France in respect of sports betting, and also Belgium and Italy in respect of casino.
Other revenues continue to be the only growth sector. You say Win has made a maiden contribution, but social gaming is notably absent from the release. What's the picture there?
Win has largely been in the mode of developing new games and also optimizing the existing games that it had already developed. So, for example, Cheeky Bingo on Facebook, that's currently being optimized. That game has actually now reached profitability, and they're looking to scale that out now through further marketing. We're also building new games for our partners. So, for example, we've built Stardust Casino for Boyd, and that's launched now and up and running. And we're in advanced discussions with one of our other partners for a similar game.
And how have Calixa and the World Poker Tour performed?
Well, let's start with Calixa first. Calixa took a number of significant steps forward in 2013. First and most importantly, we've put in place the management team that we think are capable of taking Calixa to where we want it to be in future in order to fully realise value from that particular unit. We also managed to secure a number of major contract wins in 2013. Which will benefit revenues in 2014 and beyond. And in terms of its innovation, that was actually recognised by it winning 2 awards. In terms of the World Poker Tour's revenues were down 8% year on year. But I think you need to dig a little deeper beneath those numbers. Where it was down in revenue was based on sponsorship revenues from third parties. And the reason we saw the drop was because since the arrival of Jeffrey Haas to run our poker unit, the World Poker Tour has been much more now integrated into our own poker business and is being used to support the business in the US as a case in point. So we're seeing more what we call internal sponsorship now of party poker rather than going out to third-party sponsors. And of course, we wouldn't recognise that intercompany revenue as such. So that's really the reason why the revenue drop is there. That having been said, it is very much part of our strategy. For example, this year we've moved the World Poker Tour Championship event to the Borgata Casino in New Jersey.
Given that there is still work to be done, when in 2014 do you expect to see a real return to growth?
Well, we expect a return to growth in 2014 in both revenue and clean EBITDA terms. And as you would have seen from current trading, we're showing sequential growth in all product verticals.
So what's your view of current trading?
We're very pleased to see sequential growth in all verticals. I mean, clearly we would expect that in any event from seasonality, but it's in line with our expectations.
Clearly, the US is important. So what proportion of revenues do you expect the States to be generating by the end of 2015?
That's a very difficult question to answer because there are so many unknowns. You know, which states are going to regulate? When are they going to regulate? What products are they going to regulate? What tax rates are they going to regulate? I think if we see no further regulation in that time, then I expect the US will remain a relatively modest proportion of revenues. However, in the event that some of these other states that are talking about regulating do move forward and regulate, particularly material ones like California, then in fact you could see the US as a very meaningful part of our revenue and EBITDA going forward.
And how do you expect launches in the US to impact on margins in that period?
Well, California, if we take that as an example, where we've got 2 bills that are being pushed forward right now, that state is around 17% of the US market in its own right. So clearly, if that one was to regulate and we were to secure a similar market position to like we have secured in New Jersey, then that could have a significant impact on margins. But again, it does depend on what products are regulated, what tax rates, etc., etc. But based on the draft legislation, then it could have a very material and positive impact on margins. Of course, initially, you're always going to have some startup costs prior to the market opening. And so for that reason, baked into the current forecast, we haven't assumed any further launches. If and when some of the draft legislation actually moves forward and gets passed, I think then we would update the market with guidance as to what we expect that to mean, both in the short term with the startup costs and also then going forward as to what the margins would be longer term in that market.
Clearly, mobile and touch and new products and games releases are a central part of your strategy. Will all that development be done in-house?
Not necessarily. Clearly, a significant part will be carried out in-house, but we also think depth of offering is important. So what we've been doing is opening up the platform and creating new APIs which make it easy for us to integrate third-party content from the likes of Bally, WMS, Amaya, companies like this. so that, again, our players have a very diverse offering as well as some proprietary content that is exclusive to us. So that's basically our strategy on mobile.
You still have a lot of cash despite dividends and share buybacks and a new loan facility. What are your plans for cash?
Well, you have to obviously strip out the client fund when looking at our cash. As you would have seen in the release, we have increased our dividend by 5% to 1.8 pence per share. So that makes the overall dividend for the year 3.6 pence. Going forward, I mean, we always look at the balance sheet, and if we think that we're building up any surplus cash over and above what we need, then we'll, look to return that to shareholders, whether by, special dividend or buyback. And in fact, that might be driven going forward by some disposals of non-core assets, but we'll have to wait and see. But clearly also we need to consider the operational needs of the business, in particular what capital requirements we might need for some of the markets that are looking to regulate. I mean, we've just been talking about California, so we don't know, for example, whether we might actually have to put up some cash deposits to secure the license there, or to what extent there is going to be requirements for ring-fence player funds, etc., as an example. And then, of course, we want to keep our powder dry as well in terms of ensuring that once that market opens, we have got sufficient cash to fund an appropriate marketing campaign to secure a leadership position in that market.